Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Welcome, everybody, to the podcast and the conversation. I'm really excited today to host Trevor Marshall, who is the CTO at Current, one of the most innovative neobanks out there with a very interesting story. So I'm really excited to dive deeply and learn everything that we can about the journey. Trevor, thank you so much for joining us today.
Thanks for having me, Lex. I'm excited to go deep.
Absolutely. So to start, let's just paint a bit of a picture of your education and, how did you get pulled into financial services?
Absolutely. So I maybe even before I was at college, I got to Columbia through actually my very deep passion of music. I was on this track to become a musician coming out of high school. I had spent a lot of time in a conservatory prep program, so definitely not sort of a deep background in math or computer science or anything like that. But when I got to Columbia, I started taking sort of in my first semester an economics class that had some math requirements. And I found that college math was much more interesting and much more exciting than high school math. And so I really started this journey towards mathematics and eventually computer science a little bit later than a lot of folks who end up in those fields. In particular, I got really excited about combinatorics, number theory, and that sort of got me in the direction of cryptography. And one of the things that was just a huge coincidence and a big sort of factor in my direction was I started college at the same time that the Bitcoin white paper was released. And when I was an undergrad, I had the benefit of having a few friends who were sharing this PDF back and forth. And it got me very excited about Bitcoin. And so as I was really sort of coming to maturity in my education, I was at the same time getting exposed to something that I found really exciting, this Bitcoin thing. Additionally, one of the sort of great coincidences is that I was in New York at the time, and early Bitcoin, there was quite a lot of folks in New York, and I got to be, part of early meetups, spending a lot of time with people and getting to really understand some of the potential that people saw in this technology. So coming sort of in my undergrad experience, I was very focused on figuring out how I could make digital currencies, Bitcoin in particular, because there wasn't really a lot of other things being considered at the time, the focus of my career. And the first place I saw to be able to do that, and there wasn't, the same sort of suite of companies that were available where you could focus on crypto, was, okay, if Bitcoin is just missing this sort of magical, foretold institutional adoption, maybe I can be part of the force that brings Bitcoin into that mainstream. And that's what directed me towards foreign exchange desk on Wall Street. I kind of had this super, young and naive idea about being able to bring Bitcoin to Wall Street. And I thought a foreign exchange desk would be the perfect place for that. And very luckily, and another great coincidence of my career and life so far, has been the guy who hired me at Morgan Stanley, Stuart Sopp, who is now been my boss across 4 companies, including Current, where he's the CEO, immediately understood sort of the importance of Bitcoin in particular in the fabric of the way that payments worked globally. And so even though I wasn't able to bring Bitcoin to Morgan Stanley, it drew me eventually to Stuart. And that's really where the story of Current begins.
It's interesting to hear about Morgan Stanley, as a recipient of your Bitcoin interest, because I think we're still in this place where a lot of the large investment incumbents have have this deep-seated allergy to asset classes that run on different architecture and perhaps are more interesting to different generations than the ones that built those investment houses. And then the other thing just to remark that I think is really maybe just to pin the idea is, trading and FX is quite different from banking. The idea of exchange, the idea of money in motion is quite different from the idea of personal finance and deposits and goals and savings and things like that. What pulled you from capital markets towards founding a company that focuses on deposits, that focuses on savings? And maybe you can tell us a little bit about that founding story.
Definitely. So in 2014, Stuart left Morgan Stanley, and I was working on an electronic trading desk still at Morgan Stanley, but it wasn't really where I wanted to be. I really wanted to be back in the fabric of crypto. And shortly after he left, I followed him, and we did a couple of different projects. We were doing some foreign exchange prop trading, but we were also starting to work on a Bitcoin statistical arbitrage strategy that we were hoping to raise a fund around. And as we were raising this fund and thinking about the broader impacts of what this thing actually could be, we realized that there are two ways to make money. Ultimately, it's value transfer, which is very much what trading is all about. It's like, okay, a bunch of people have money. How do I get money off of them through the markets? There's efficiency mechanisms, and you serve a place in making, commerce possible and transactions possible and the financialization of companies possible. But it is very much a zero-sum game. What we were more interested in was value creation, which is really that other half of how you can make money. The reason we thought that was more interesting is A, the opportunity is much bigger, but B, it was a far more desirable thing for us to be creators of something new that other people could use. There's sort of that innate drive to create that a lot of people have that can only be fulfilled by building something new. And as we were starting to raise that fund around the Bitcoin Stat Arb, we met Garrett Camp, who's one of the co-founders of Uber and the founder of a startup incubator and VC called Expa. And we sort of at the same time came to the conclusion that something in consumer finance was going to be really interesting, in particular with the way that technology via these digital currencies was so quickly evolving that we basically said, okay, let's go and build the consumer experience. Let's actually go and build that value. And that's what led us to, in 2015, officially incorporating as Finco Services Inc., which is now Current, DBA Current. And in those early days, one of the benefits of going through more of an incubator-like structure is that you get a lot of time, and there's an expectation to actually build tons of prototypes, to really experiment, as opposed to, there's a lot of other routes into venture-funded companies that usually start with, hey, what's your MVP? Prove this out, and then you get funding, right? And that funding sort of drives you in the direction of the MVP. We had the benefit of getting funding in a setting that expected experimentation, lots of different ideas, and no forced commitment to a direction too early until you had actually build something out. And I think that was a huge reason why we ultimately ended up in the space that we're at today, is we spent about 2 years building all sorts of different prototypes. One of the first things we were building in the early days was an API convenience layer for Ripple. So Ripple at the time was one of the very interesting applications that we saw for being able to bridge dollars with digital dollars, so fiat and crypto. And the way that our early prototype would work is we would literally take cash from people and we would extend it via our trust node on the Ripple network, and you would have a digital dollar. And that was sort of the underpinning of what ultimately became our own core banking engine, because you don't have any of this financial technology convenience layers like processors, core banking systems. We built all of that with the idea of having a digital currency backend, or like a bankless backend. And we had a bunch of other iterations of that. We realized that there wasn't a huge business yet in having a digital dollar in 2015. It didn't give you a lot of benefits that it does now. But we wanted to be positioned so that as we built a consumer-facing product, we would have that flexibility in the financial backend. And that's really what drove us towards ultimately in 2017 launching our teen banking product. It was a way to flex this core banking engine that we had built with the purpose of having an abstracted backend for a use case that we saw was not really being well addressed. So we could go acquire customers, build a differentiated consumer product, and eventually expand further and further into consumer acquisition and ultimately detach and provide that pure abstraction away to financial outcomes, which is sort of where we're at now. It's been almost 7 years, and it's been a ton of investment in that core technology to get where we are today and prepare us for where we're going in the future.
Yeah, so let me double click on all of these things and let's define them, right? So in the US, core banking is an oligopoly. There's roughly 3 providers, FIS, Fiserv, and Jack Henry. There are a couple of upstarts, and that's the chassis for the existing banking system. And there's something between 5 and 10,000 banks in the United States. The picture looks a little bit differently globally. Other countries tend to have fewer banks than the US, because we're so decentralized with our federation of states. It's a market that has network effects where it's beneficial to, create a big platform and then have lots of distributors sitting on that platform. Can you talk? I mean, it's almost, you're saying that you wanted to go after the teen banking market by building out a core, which is, it's like, I want to go to a restaurant next door by building out a space shuttle, going to the space and then coming back down next to the restaurant. Can you talk about, in your mind, in your words, what is a core banking system? Like, what are its functions? And maybe describe a little bit what it is that is important to build from scratch.
Yeah, absolutely. Absolutely. And just to clarify, the intention was actually to get to this place of being able to build any type of financial experience and control that destiny. And the first stop on the way, really to attract investment to enable us to get to that place, was to build a differentiated product, the teen banking product. I think we didn't really get to teen banking is the thing we want to do. We want to build a platform that can enable any financial experience, but we need to go and build a differentiated product that will allow us to raise capital to go and pursue those goals. So it was sort of the launching pad for us to get more into the position that we envisioned from the beginning. Sort of this mission of connecting the world financially was a very early mission statement that we had. But to talk a little bit about the core banking technology and why teen banking was one of the first things that we were able to do, fundamentally it comes down to dollar ledgering. So it really, the core of what we consider our core banking is a system of record, which is completely controlled by us. So, and what I mean by that is, you mentioned the sort of the big 3 in financial technology. Ultimately, for checking accounts and for deposit-based experiences, the experience is driven by transactions where a dollar turns into something else. So whether it is a dollar that is being paid to another member through peer-to-peer transfer, or a dollar that is being deposited through a cash deposit merchant network, or a dollar that's being used to purchase any sort of asset or be used on a debit card, all of these interactions form transactions, and transactions ultimately roll up into a balance. And the reason it's important to actually control that system of record is because your fundamental feature set is a type of transaction, you can encode any type of integration between a user's dollars and what those dollars are spent on or transferred into if you control the way that balance is calculated from those different interactions. The alternative to building that yourself is to work with one of these third parties to encode those experiences, which fundamentally sort of detracts from your ability to differentiate, because these larger companies are incentivized to take those integrations and then immediately resell them to other members or other clients on their list, because they benefit from the economies of scale. For them to build custom experiences for just one client, really is orthogonal to why they are well positioned sort of to make money and to be successful. So for us to control our own destiny, it started with building that system of record, which has a ton of other implications, especially with the regulatory backdrop of the US, because there are so many things you have to get right in order for that to be possible. And that's sort of the long game that we're playing here, which is because we can control these experiences, we ultimately can build products that will take either a long time for others to catch up with, or will not be differentiated because anyone else who's using these third-party providers will immediately be able to enable those experiences once they're created for us. So that's really where it starts, and I'd be happy to talk in more in that direction or more about the other aspects of the core as well.
Yeah, so it can't be overstated just how hard it is to recreate this piece of, or build in a modern way, this piece of technology. Can you maybe give some examples of like how you would prioritize the things that a core can do? Like what are some things that are basic that responsible for 50% of the types of things that people need? And then what are sort of a couple of edge cases that you have to put in that maybe you didn't expect to, but end up taking all this time to get right?
Yeah, absolutely. There's a ton of fundamentals to that system that are important. Ultimately, a lot of the real complexity and something that we think about a lot comes down to balance. The number that you see in your checking account is a result of all of the debits and the credits that have been exhibited on that account, whether it's through card purchases, direct deposits, all these different things. And all of these transactions, a single transaction, for example, an originated ACH transaction actually has many steps and phases. You have that first entry in which, in the example of originated ACH, and just to make sure I don't use too many, technical words. For example, if you connect another bank like a Chase account to your current account, and then you deposit $100, you're originating an ACH debit. That's, sort of what that means. But the first step is that gets inserted, an event of that being written into a file, and eventually you make those funds available to the customer. So that example is a two-step process in which there are two events that happen. And when you calculate balance, you have to make sure that it's when that second event happens, which is the funds are available to the customer, that you actually provide a calculated credit to their balance. But from a user experience, if I'm in Current and I'm making that ACH deposit, I want to see in my history inside of the app that, okay, there's a deposit that's on its way. That's just a very small example of all of the sort of complexity that ultimately comes into a user experience. But once you get into the world of balance calculation, where that has to be sub 5 milliseconds and recalculated several times at every point of interaction, you start getting into where you can actually leverage modern technologies to build an extremely scalable solution that enables you to add all sorts of new transaction types without compromising the fundamental requirement of calculating that balance. So just to give one other small example, and I'd be happy to go deeper if you think it would be interesting. There is the idea of a distributed lock that has to happen on a user's ledger. A distributed lock is basically, if I'm making a card purchase, I need to ensure that that balance is the same when I decision that transaction at the beginning of the transaction and at the end of the transaction, because there's many things that need to happen. We have to check fraud rules. We have to ensure that there are, the correct settings on the card, that spending limits are not being met or exceeded. And at the same time, other transactions could be happening because we have a full transaction platform. That user could be sending a peer-to-peer payment. That user could be receiving money in some other way. And so to do this in a way that's horizontally scalable, so is basically performant for millions and millions of users, we've had to develop a lot of technology that facilitates those types of interactions. And I know that's fairly technical and we can go more into that, but it's just an example of some of the things that we have to think about that maybe some of our peers don't spend that much time thinking about.
Yeah, absolutely. And like you say, it is quite defensible. Are you using, or were you trying to use that Ripple chassis or some other cryptographic chassis underneath, or are you using more of a Web 2 stack for this?
It's very much a Web 2 stack. I think one of the things that we found pretty early on was the scalability. So what you get with most of these, crypto-based chassis, and I like that term and concept a lot, is you get the benefit of sort of finality, and you get the benefit of there are rules that exist to sort which transactions are accepted. The challenge is that almost every consensus mechanism that exists today has a certain amount of confirmation time that's required, and it gets ultimately linked into a certain amount of transaction speed. We're doing thousands of transactions a second on our platform today, and and this is with a percentage of the US population, and we have aspirations to ultimately create transactions for everyone globally. With the level of transaction throughput that's required, there's not yet that distributed consensus capability. So there is very much a place in the ecosystem to have that fully integrated sort of verticalization of dollar ledgering, but then the ability to create integrations out into those digital experiences where you have distributed consensus and a little bit less trust that's required to facilitate those financial transactions. That's, I think, what's super interesting and what we've been focused on for many years.
Absolutely. So let's shift towards maybe just a high-level overview of the company today, and I'll follow up with a question about kind of your distribution and go-to-market and profiling and so on, which I think is really, really interesting. But in broad strokes, what is Current? What does it offer? What's the scale of the company? Let's just lay down those foundations about how it looks in 2022.
Yeah, absolutely. I think really it starts with our mission, which is to improve our members' financial outcomes. And that sort of drives a lot of our product direction, and in particular, our product sequencing. So what we are today in the market, we're very much in this challenger bank category. But as you mentioned sort of earlier in the podcast, a challenger bank in the US is really a technology company that builds partnerships with regulated banks and entities. And so we work with 3 partner banks today, but what we provide is the full technology services. And from our customers' perspective, we are sort of that banking experience. And so what that comes down to in terms of feature set is we have account numbers in which you can receive your direct deposit. We have physical and virtual debit cards that you can use to spend at any merchant globally. We have the ability to deposit cash, the ability to pull in funds via ACH, to deposit checks. Ultimately, we have a platform that looks very much like core financial services at any of the 6,000 or so banks that you also mentioned here in the US. Where the differentiation starts coming in is where we have certain features that have taken the legacy financial platform similar to this a little while to adopt and probably won't really get there. But things like integrated credit or tactical credit. So things like extending access to funds for customers when they receive their paychecks early, which is something that has driven us, Chime, Varo, and others. That was a real accelerant early on. The integration of a credit-like product of a no-fee overdraft facility, which is something we call Overdrive, and that's sort of directly integrated. That's user being able to spend below zero. It's actually a concept that's very common in the UK, but really didn't gain prominence here in the US until a lot of the fintechs here started pursuing that. Then we added in things like a point system, so the ability for merchants to fund rewards to our customers through our platform and through sort of the attribution that we do. And as we look forward, we just recently launched a high yield savings account, which we think is fairly differentiated in the way that we provide access to that high yield to our customers. And of course, moving towards a lot of what we had envisioned early in the company, which ultimately now, luckily there's a term for it, is a connection to DeFi to our customers. So we have about 3.5 million customers today. We're very much focused on acquiring customers where we serve their needs best. As a result, that has been many people who have been disregarded by larger financial institutions, people who were previously using cash or prepaid, people who were paying a tremendous amount of fees at banks. But as we expand the product set, we've already started to see a demographic shift towards really just your average American. And that's sort of where we've been for the last year or so. And as we add more features, we're starting to be able to push out that bell curve and really acquire sort of across demographics.
Really interesting how the stacking happens and what drives adoption at different points, both like in the fintech market cycle, but also in the maturity of the company. I have two questions: one about economics and one about psychographics and customer acquisition. And I think maybe we'll just start with the customer acquisition side, because this is a key bit to growth. It's the key thing that a lot of venture investors want to see proven out, is marginal customer acquisition working. Can you talk about how the company built out its marketing and customer acquisition organization, and maybe some of the industrial logic for how you invest to grow, and like what good customer acquisition looks like, and just what is that? What is that motion? What is that practice for the company?
Yeah, absolutely. I think a big sort of, and it gets a little bit to the demographics, but our customers are very young. Something that we've watched very closely is what percentage of our users are we their first bank account. And that percentage was surprisingly, and is always continually surprisingly high. It's around 40% of our customers have never had a bank. And there's a couple of reasons for that, but the biggest reason is because they're fairly young. And I think that's mostly a credit to the fact that our marketing strategy, the thing that has worked best for us, has been our influencer strategy. We have a couple of very large partnerships. Mr. Beast, who's probably the largest YouTuber in the US, I think he's number 1 or number 2 globally on YouTube, and many other. I think we've sponsored certainly close to, if not over 1,000 different content creators, and that sort of trusted voice has been a big part of what has made our acquisition at scale successful. And so that sort of strategy has been a big part of how we've grown. And the fact that we have a product, ultimately the marketing can only follow the product and the product availability. But if you don't have a product that people want, it becomes very difficult to sell them that. You can try to dress it up as much as you can and sort of reiterate and drive brand awareness. But we think that a lot of our acquisition is a credit to the product that we have, combined with sort of a unique way of letting people know about who we are and how we function.
And if you were to double click on that influencer strategy, is it affiliate marketing, or is it like brand marketing? And I think what I'm interested in and trying to get at is also this concept of the creator economy has really changed over the last 5 to 10 years as your company was growing up. Also, this new way that people consume entertainment and social networks and so on sort of also crystallized into something that made a lot more sense and became more mature and professionalized. Can you talk a little bit about that co-evolution and sort of like what are the what are the financial hooks and what are the right relationships for folks who want to work with influencers to grow?
Yeah, I think we've been really benefited from the fact that our VP of marketing is Adam Hattie. He is definitely one of the pioneers of what we now call influencer marketing. I think in 2014 he was paying Twitch streamers who are doing FIFA Twitch streams, which was a very early sort of content creator of the new platforms integrations. He gave Mr. Beast his first ever sponsorship. And so he has a ton of relationships that we've been able to, open the door with. But ultimately, we've really figured out a way to value these integrations. So we look at it from both a brand lens, but also a performance lens, which is not something that you can usually apply to things like celebrities or things like more broad, widespread brand marketing. But we do look at a performance lens of like, how does this specific video perform? We model things like the view count, the way that you can continue to have a long tail of acquisition from certain content, and the shape of those things. That's very much a part of the way that we value. And so I think there's, one, having the right relationships is critical. You need to work with people who trust you and that you trust. And we have many people on our team who are building those relationships. But then you also need to approach it with the right model and framework so that you can properly value interactions, and you can either justifying paying more or know to spend less on certain integrations. I think those are the two big things for us.
Awesome, fascinating stuff. And I think the stat that you have about so much of the members being using you for the first time as their kind of their core account is really, really interesting. Can we talk a little bit about we've covered the product set. Can we talk a little bit about the economics of the business in terms of how you are set up and how you want to be set up? And I mean that from the following context. There's a realignment right now, I think, especially as part of the Web3 movement, of generating incentives and generating pricing and creating a community that benefits from using a service, and the service benefits from being used by the community, and so on. And at the same time, there is, I'd say, like a trend, maybe more Silicon Valley fintech than elsewhere, about finding places where prices are really broken, and you can sort of do these hacks around them. So for example, buy now, pay later, living off of interchange in order to do credit underwriting is a really interesting hack. Or, Robinhood living off payment for order flow in order to do sort of consumer finance is also an interesting and strange kind of market structure hack. When you think about your economics and how you want to charge your customers and where you want your revenues to come from, what are the main categories, and sort of what have you learned over the years?
Yeah, I think the big hack for us, for Chime, for Varo, for the big challenger banks here in the U.S. has been the regulatory hack of unregulated interchange, and that's a very specific. It doesn't necessarily mean unregulation. It's just a very specific term that applies to post Durbin 2010 Durbin Amendment of interchange regulation. There is the ability to have a higher interchange, which is, when you use a debit card and that fee is paid by the merchant to accept the card, that fee flows its way across the network to the issuing bank and ultimately to the program manager, which is sort of the regulatory name for what we do in our debit card processing. And that Durbin limit, which is, banks that have less than $10 billion in assets, has a much higher fee that you can earn from those transactions. And we've benefited greatly from that. So we can actually build a debit product that doesn't have to be monetized through overdraft fees, minimum account fees, and a lot of the things that you see at the big banks. And so that's been, that's a large driver of our revenue today. We've been able to, on the economic side, create a fairly high margin version of that because we're doing so much of that core processing ourselves. And I think it'll continue to be a large source of revenue. But I think there is some really interesting business models that start becoming available as we move more towards DeFi. So a lot of what DeFi is really breaking open is it's the ability to own pieces of the financial system. It's the ability to, instead of having a bank or a sort of a traditional counterparty in the center of transactions, it enables people to own pieces of the financial infrastructure. And I think there's some pretty interesting monetization that becomes available then if you're facilitating sort of that onboarding of ownership. There's a lot of models that are out there. I think, the idea that the community benefits as the entire network increases in value, which is something you see, really commonly with NFTs, where you have, a large collection, and the second the floor price moves up, everyone is sort of tangentially benefiting, at least on paper, and then more explicitly in governance tokens and other utility tokens of DAOs. And so I see the future of Current's monetization more towards that, although I can't speak directly to what that looks like in 5 years from now. That's pretty much the direction I think that a lot of companies will need to move towards if they're to remain sort of relevant in a business model context.
Yeah, absolutely. Offline, we'll talk about that MetaMask integration. Got to get you guys connected. Can you then talk about that bridge, that integration bridge that you're now starting to engage with by connecting into DeFi products? I think the company's done a really nice job of positioning all these financial experiences as financial experiences, right? But you're able to do something like offer a 4% interest rate on a savings like account in part because you're availing yourself to asset classes and opportunities that the more orthodox banks are not set up to do all across the chain. Can you describe sort of both how you got hooked conceptually and so from a business perspective on trying to integrate into this asset class, and then what does that integration actually look like?
Yeah, so I think the concept is really important, and it is around that idea of ownership. And in particular, the thing that really got us excited is when stablecoins became far more prominent than they were a few years ago. I think one of the sort of pivotal moments in DeFi has been the successful scale up of collateralized lending like Compound, where you have the ability to deposit stable assets and earn returns on those stable assets. And ultimately, what you're doing there is you're providing, you're performing the function of collateral provision, and you're benefiting from the access of that, sort of the same way that a bank benefits from having a large deposit base. With these on-chain contracts, you're able to perform that function of stability, and you get rewarded for it. The other large trend, which was one of the things that really started to get us hooked, was the growing prominence of validation as a consensus mechanism. So, Ethereum 2 and the staking that's available there was really one of the first places this was contemplated. And you've seen a lot of other projects develop additional scalability solutions in the consensus mechanisms, things like delegated proof of stake, which comes with a lot more scalability today than other sort of staking mechanisms can provide. And those also offer sort of a window into this idea that some of these experiences can exist not purely trustlessly. Like the only purely trustless consensus mechanism today is the proof of work mechanism. And Bitcoin in particular, I think really still stands the test of time for ultimate decentralization. But there is a place to have less trust, not no trust, which I think is sort of like a Gavin Wood concept. But or at least he put the words to it. And I think that's also how we think about Current and how we think about our role here, which is most people are not comfortable managing their own keys, managing their own assets, or even getting over that educational barrier and that hurdle that exists. There's still so many people who are not participating. It's very easy for us sort of who are in the weeds to think, oh yeah, everyone has access to this stuff. Anyone can do it. But really there's that educational burden, there's that comfort burden, there's that trust burden. And companies like us really have the opportunity to facilitate that bridge. And so when it comes down to the actual integration, it goes directly to what we've been building towards with our core technology. By performing the function of dollar ledgering, it is very simple for us to begin doing things like seamless integrations into digital dollars away from the dollars that are sitting in our partner banks' accounts. And we can do that with a lot of different partnerships. We can do that sort of ourselves eventually. But that transition point is something that we've been really focused on enabling for quite some time now. And so over the next few years, what you'll see from us is more and more native integrations. So basically moving our customers towards Web3 type products, but in a way that doesn't require that huge overhead that exists today. Right now, there is very much this educational challenge that exists. And there's a technical challenge too, because if you mess some of these things up, it can be catastrophic in terms of, not being able to access your assets. So that's really what the integration comes down to, is us providing that convenience layer to gain access to these technologies and opportunities.
Thanks so much for that answer. It's really fascinating stuff. Unfortunately, we're out of time until the next time. And so tell our audience where they could learn more about you, as well as learn more about Current.
Well, I wish we could spend a little bit more time, and I'm sure we'll have more conversations in the future. You can find me just on LinkedIn. I post kind of everything that we're talking about here and other content there. And Current is just current.com, or you can find us in the app stores. And thanks so much for having me today. I've really enjoyed our conversation.
Trevor, my pleasure. Thank you so much for being on.
Absolutely.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.